Corporate Finance Core, Topic 6, Capital Budgeting, Learning Objective number 2. We're going to evaluate investments with CapEx, revenues, and OpEx. So we're going to start off an example from the textbook. Baldwin, a recreation company, is considering a capital expenditure for a machine to manufacture brightly colored bowling balls after conducting promising research. Now that promising research, which is already conducted, will be a sunk cost. We're going to ignore it. The balls will be manufactured in the existing company facility that could be sold today, and that cost that cash flow that I could have received today, that foregone opportunity will be included. And the following worksheet has detailed assumptions for revenue, OpEx, CapEx, and working capital. And something new, the CapEx is going to be depreciated using an accelerated schedule, not a straight line. So we're going to use the Maker's Modified Accelerated Cost Recovery and use that instead of a straight line. So here are some of the assumptions. The market research conducted 1 year ago today is $250,000. That is a sunk cost. I'm going to ignore it. However, the facility they're going to use to make the manufacture the balls could have been sold for $150,000 today. So I'm going to include that as a cost today for the project. However, that I'll assume that after the life of this project, which is going to be 5 years, I'll assume that I'll sell it then. The cost of the machine, the CapEx is going to be $100,000. That's going to be depreciated over 5 years using modified accelerated. And let's take a look at that. Now, a couple things about depreciation. IRS says that you must depreciate the full cost of an asset. That is not the same as the financial accounting standards, which say you only depreciate the difference between the cost and the expected salvage. So never do that. Never. In my course, because we're focusing on cash flows, not the financial reports, we're going to depreciate the cost of the asset, not the cost minus expected salvage. Now, the after-tax salvage when I sell the machine after the end of the project is going to be whatever you sell it for, the salvage or the resale value or the residual, sometimes called, minus the tax on that salvage, which is going to be the tax rate times the difference between the salvage and the net book, where the net book value is the net asset value at the time of sale, which would be what you bought it for minus how much has been depreciated as of that time. Now I'm going to use the 5-year accelerated depreciation for the bowling ball machine, and actually a 5-year accelerated. These are the recovery periods, and it gives you some description of the different classes of depreciable assets. So 5 years includes cars and trucks, computers, and peripheral equipment. So this it's been determined by the accountants that this machine should be depreciated over 5 years. And actually, what it actually means is the 5-year depreciation is actually a 5.5-year depreciation, because there's a little bit in the 6th year. So this depreciation is accelerated because if I did a straight line over 5 years, I just do 20% a year for 5 years. And what you see is I'm doing 20, then 32, 19, 11, 11, then 5. So it's a little bit heavier up front. It's accelerated depreciation, and that reflects the fact that assets maybe lose their value much faster in the early part of their life and a little bit slower. Just like when you buy a car, you lose a lot more in the 1st year than you did in, say, the 5th year. So again, the assumptions, I'm going to accelerate this. I'm going to do a depreciation using an accelerated schedule over 5.5 years. And I'm going to sell the machine at the end of the 5th year and end of the 5th year and sell the machine for $30,000. Here's the assumption. The price of the ball in period 1 is $20. That price will increase by 2% a year. The operational expenditures to create the ball is $10 in year 1, and then those costs are going to increase by 10% a year. So it looks like I'm assuming that my costs are increased faster than my revenue. I'm going to need $10,000 today in working capital. So that's going to be period 0 today, $10,000, and then periods 1 through 4 net working capital is going to be 10% of that year's sales. However, at the end of the project's life, this 5 years, I'm going to get rid of the machine, no longer sell the balls, and liquidate the working capital. So that working capital is going to go to 0. Let's use a tax rate of 34%. And let's go ahead and do the calculation. Oh, and the discount rate is 10%. By the way, the details behind the 10% networking, or $10,000 initial net working capital, assumes I'm going to need $1,500 in cash today, $9,000 in receivables. There'll be $3,000 in payables and $2,500 in inventory. So that justifies this 10% sales. So it gives you an idea of what the assumption is, or the assumptions were, to come up with the net working capital. So let's go to the spreadsheet and calculate whether the after-tax free cash flows of this project and see if we should do it. See if the NPV is greater than 0 or that IRR is greater than that discount rate. So let's go ahead and do that. Some of it's done for you already. We're going to sell 5,000 balls in the first year, and that goes up to 8, 12, 10, and 6. The ball price is going to go from $20, increase by 2% a year, to go up to $21. And here's my accelerated depreciation percents by year, including the 6th year. And here's my cost, my operational cost per ball, increasing by 10% a year. So I have my revenue, number of balls sold times the price per ball. In 24, I have my operational expenditures, my cost of goods sold for those balls. And let's go ahead and do EBITDA. I'll take my revenue minus my operational costs, and I got my EBITDA. My depreciation is going to be the CapEx of $100,000. I'm going to anchor that by putting dollar signs, multiply times the accelerated percents in 19. So I'm going to go across. We're going to calculate our EBIT. Take our EBITDA minus our depreciation. And so I get my EBIT. And let's go ahead and just do EBIT after tax by taking the EBIT times 1 minus the tax rate of 34%. So there is my net operating profit after tax, otherwise known as EBIT after tax. Let's now calculate the net working capital. The assumption is I'm going to need $10,000 today. So I'll have a link to that. And then it's going to be 10%, anchor that, of sales each year. I'm going to take that through the 4th year. However, right here I'm going to put a 0 in year 5, and I'm going to change that style so I don't get confused later, because that's an input. So I'm going to need no working capital in year 5. And let's also calculate the net book value of our machine to calculate the after-tax salvage later. The net book value on year 0, or time period now, is $100,000. And then that $100,000 is reduced by the yearly depreciation. So you can see it going down from 100 to 80, and it's worth $5,760 by end of year 5. And let's go ahead and calculate our free cash flows to the firm. I'm going to start with my after-tax EBIT. First year, 19.8. Copy that across. I'm going to add back my depreciation in year 1 through year 5. I'm then going to subtract the CapEx in year 0. That's going to cost me $100,000 today. I'm then going to get in year 5 $30,000. However, I got to pay taxes on that, so I'm going to reduce that by the tax amount, which is going to be 34% times the difference between salvage and its net book value. So this is what it's worth according to the IRS. So according to the IRS, it's worth $5,700, because I'm going to be taxed on the difference between $30,000 and $5,760. So my after-tax salvage in year 5 is $21,758. I could have sold the building in which I'm doing manufacturing for in period 0 today for $150,000. I'll just make the assumption in year 5 I sell it then for the $150,000. So in year 5 I add that number back. So I have my CapEx, CapEx opportunity cost. So in other words, I could have sold this before. And lastly is my net working capital. Goes to $10,000 at period 0. And then I'm going to take the change. So I'm going to minus the change. And you can see it comes back in year 5 because I'm going to take working capital down to 0. And now I have my free cash flows of the firm. EBIT after tax, add back depreciation, subtract capex and salvage. I'm dealing with my opportunity cost there. So that's not going to be there on most examples we do, but in this example it has it. And then I'm going to subtract my change in net working capital. So there are my free cash flows. I can then calculate the NPV of those free cash flows. Notice I take the NPV of periods 1 through 5 using the discount rate, and I add back the cash flow at period 0. And then I have my IRR. And so this project, using a discount rate of 10%, has a net present value of $51,590 and an IRR of 15.68%. So I'm going to do this project using my rule that if the NPV is greater than 0, and if the IRR exceeds your discount rate. So that's the first project. Let's look at a smaller project. We're thinking, here's another company is thinking about launching a monthly digital marketing plan. So it's OpEx only. And it's considering the launch of a 1-year digital marketing plan. The following worksheet will show all the cash flows, calculate the NPV and the IRR. So here's the basic assumptions. I'm going to spend 2 months spending $30,000 of OpEx. Month 1, month 2, to get ready for this marketing plan. So it's kind of just a planning cost. Then starting in month 3 and going through month 14 for 12 months total, I'm going to spend $25,000 in marketing spend, digital marketing spend, and that's going to generate sales of $45,000. However, those sales have cost of goods sold associated with them of $13,000 per year, and that's going to give me an EBIT every month of $6,500 for a spend of $25,000. So it's going to give me which includes a spend of $25,000. That gives me an EBIT after tax of $48,750. And the assumption on net working capital is at the end of month 2, I'm going to move net working capital to $3,600, which is a percentage of sales. We can just think about that as maybe receivables. And then at the end of month 14, I'll take that down to 0. So what you see is the net working capital increases in month 1 from 0 to $3,600. That's a cost, remains constant, and then I take it off. So let's take a look at the spreadsheet and calculate the IRR and NPV of this monthly digital marketing plan. I'm going to click on Marketing Worksheet, and you can see it's all completed except for the IRR and NPV. Again, we see all our costs, revenues included. And so the last thing we just have to do is calculate the IRR. Now, if I just calculate the IRR of the free cash flows, starting with the initial cash flows, that will give me a monthly IRR. But since these are monthly cash flows and we want IRR to always be annualized, we want to multiply times 12. So it has a 42% IRR. So you can think of that as the annualized rate of return. And then the NPV, since this is a monthly project, I'm going to take the discount rate of 15% divided by 12, and then put in the cash flows starting in month 1. Since this is not period 0, in month 1, I can just start with the first cash flow. And there's my NPV. So this project has an NPV of $8,000 and an IRR of 42%. And our last little investment we're going to look at, actually not a little investment, is Walmart is considering the launch of small banks in each superstore. All right, the following spreadsheet or worksheet is going to calculate the annual cash flows, NPV and IRR of the investment. So it'll be looking at, say, just one store, and then you can multiply times the number of stores to figure out the actual the ultimate value. This is an infinite life investment. So what that means is I'm not going to close down the stores after 5 or 10 years. So I'm not going to make an assumption that, say, working capital goes to 0. I'll just let that working capital increase over time and not take it to 0. And also on an infinite life project like this, one that has no expected end, I can't have a spreadsheet obviously with an infinite number of columns. So at some point I just need to come up with a terminal value. some way of trying to express the value of the business from the last year I estimate to the end. And there's only two ways we generally do this in finance. We usually use an EBITDA multiple. So in the last year, you might say the business is worth 5 or 10 times EBITDA. And the other way to do that is through a growth perpetuity of cash flows. That's what I'm going to do in this worksheet. Now these banks are going to have some interesting effects on the superstore, the existing superstore. They're going to use some of the existing shelving space of the store, so there's going to be some lost sales. And there's also going to add on sales because just traffic to the bank is going to drive some extra sales. So we'll include that. Now, a preliminary analysis has been done to compute all these cash flows. That cost me $1 million. However, that's a sunk cost at this point. I'm deciding whether to go ahead. So again, here are my assumptions. CapEx, I'm going to spend $550,000 per store. That's going to be spent in 1 year. So I'm going to just assume I'm going to pay all our expenses to refurbish these stores, and I'm going to spend that at period 1, not period 0, which is what I normally assume. So I'm going to depreciate that straight line over 10 years. The banking revenues are going to be $200,000 per year. The cost of goods sold, 60% of revenues. That would include SG&A. My net working capital starting in year 1 and going on forever would be 20%. I'm going to lose $50,000 in sales from existing stores. I'm going to add on $40,000 of sales from increased foot traffic from the banks. Tax rate is 25%. All sales grow 10% per year, years 3 through 6. And so again, remember, so I don't get revenues until year 2, and then I'm going to grow it 3 through 6. And then my free cash flow growth rate is 1% from year 7 through infinity. And my discount rate is 8% per year. And we're going to calculate the NPV and IRR. One note on this, when you calculate an IRR in a growth perpetuity problem, you can't use the IRR function, because that growth rate is both in the discount rate and in the growth of the cash flows. So you have to use goal seek. So don't use the IRR function when you're using a growth perpetuity. So let's go ahead and calculate Walmart's NPV and IRR of starting a bank in every store. So I'm going to go to Walmart Bank Worksheet. Everything's completed for me except for some items at the bottom here. So I have my revenues per year and the bank starting at 200,000, growing at 10, 10, 10, and 10. I then have my cost of goods sold. I have my depreciation, 10% of CapEx. I have my lost stores EBIT. So these aren't actually sales. These are actually the cash flow or the EBIT associated with those sales. The extra sales you generate from foot traffic, the EBIT of those. There's my total EBIT, my EBIT after tax, add back depreciation, subtract CapEx. There's no residual since this is an infinite life project. We're not just going to scrap things. So first thing we need to calculate is net working capital. Net working capital assumed to be 20% starting in year 1 and continuing. So 20% of sales. So I'm going to take 20%, anchor that, times sales of the following year. So again, there's just an assumption that it starts in year 1 and continues. So I'm going to have to build up those working capital balances by the end of year 1, even though I don't generate revenues until year 2. And notice I don't take it down to 0. And so what we now can calculate our net working capital. It cost me $40,000 in year 1 and grows with sales. So now I have my free cash flows. However, I need to deal with the fact that this store is going to be there longer than 6 years. So my 6 years is my estimation window. That's the point when I'm going to stop doing detailed estimations. At that point, I'm just going to assume that the FCF growth is going to be 1% per year. So I'm going to take my year 6 free cash flow, multiply times 1 plus that FCF growth rate. That's going to give me my year 7 free cash flow. I'll then divide that by perpetual growth rate minus, my discount rate minus my perpetual growth rate, discount rate minus my perpetual growth rate. Let's look at that formula. It's year 6 cash flow times 1 plus G. That's the year 7 cash flow divided by R minus G, which gives me the value of the cash flows the year before. So it's going to give me the value in year 6 of cash flows from year 7 to infinity. I can then add those two numbers together, free cash flows in year 6, and then the value in year 6 of 7 through infinity. I'm going to copy that across, and these are my free cash flows for Walmart opening a store, a bank in every store. I'll then calculate my NPV by taking my discount rate, comma, since cash flows do start in period 1, I can start there and calculate that NPV, 490,950, same as the PowerPoint. Now IRR, I can't use the IRR function when you have a growth perpetuity. So the only way to calculate the IRR is to go to Data, What If, Goal Seek. I'm going to set my NPV to a value of 0 by changing my discount rate, and I'm just going to watch what happens to this number here. Hit OK. At 13.95%, NPV goes to 0. I'm going to cancel and just type in 13.95%, and there is my NPV and IRR of Walmart launching a bank in every store. Now let's talk just for a minute about NPV and share price. All positive NPV investments increase the value of the firm. The impact on the stock price should be the NPV divided by shares outstanding. Of course, this is the theoretical value based on our estimates of cash flows. The only way it's actually going to increase the stock price, the actual stock price you observe in the market, is if investors understand this news of the new banks and they incorporate the news of these positive NPV investments and the cash flows into their valuations, and they bid up the stock of the price. All right, so in this topic, we evaluate investments with CapEx, revenue, and OpEx.